Good morning, everyone. I'll just leave a minute or so that people can join. Again, good morning, everyone. I'm just giving an extra minute for people to come in, and then we'll start the webinar. Okay, I think we can start. Good morning and welcome to this ECFR Africa Program webinar. We will explore how Europe and Africa are interacting in the minerals space, the tools they're using, the challenges faced, and some of the possible ways ahead. My name is Maddalena Procopio. I'm a Senior Policy Fellow in the Africa Program at ECFR. And I will moderate this discussion. Before we start, just a couple of housekeeping points. The event is public and recorded. And to the audience, you can write your questions in the Q&A box, and I will channel the questions to the speakers as we move along. Now, turning to the point, to the subject of the panel, before I introduce this great panel of speakers. We're focusing in ECFR Africa Program. We've been focusing for a couple of years on how Europe-Africa relations are changing in the energy space, including in the mineral space. Minerals have become an increasingly central aspect of geopolitical tensions owing to their critical role in manufacturing technologies needed for green and digital transitions, but also for military uses. Increasingly important at a time of increased conflicts worldwide and military spending. So this has triggered a variety of policies worldwide to secure access to minerals and protect supply from potential disruptions due to geopolitical sentiments, conflicts, and more. Africa has become more central than ever in this context, given it is estimated to host 1/3 or about 30% of the world's reserves. Of many of the minerals are deemed critical for green tech, digital, and military, as I mentioned. African countries also see these as a once-in-a-lifetime opportunity to shift away from being mere exporters of raw materials and add value locally, so to industrialize. Europe finds itself in a pretty difficult spot at the moment, highly dependent on China, which has come to dominate over the last couple of decades global supply chains for critical raw materials. Europe's dependence poses economic and industrial risks, which have triggered the launch of several partnerships with several African countries and beyond Africa as well, around developing sustainable CRM value chains in an effort to increase Europe's access to critical minerals outside of Chinese supply chains. To discuss all of this, I'm joined by a great panel. Basically to discuss how partnerships are progressing, the structural challenges, the new tools, and more. So my welcome to Sarah Logan, visiting fellow in the Africa program at ECFR. with great expertise on energy and investment in Africa and economic reform. She recently published a policy brief for ECFR, which is in the chat box, Material World, How Europe Can Compete with China in the Race for Africa's Critical Minerals. We also have on the panel Juet Masinja, I hope I pronounced your name correctly, head of the Critical Raw Materials Center of Excellence, School of Mines, University of Zambia, with an impressive background across the private sector, government, and academia, and a strong focus on the management of mineral resources. And last but not least, Louis Maréchal, Senior Advisor for Minerals and Extractives at the Organization for Economic Cooperation and Development, OECD, also with great expertise on mining and minerals governance. Thank you all for being here and welcome. And let's start the conversation. So Sarah, I'll start with you by asking you to walk us through your recent paper, in which you provide great framing to the strategic partnerships signed by the EU and African countries, looking specifically at Namibia, which is the first country that signed such a deal. Can you tell us what these partnerships hope to achieve and what progress has been made to date, and what are the challenges that have been faced?
Great, thank you very much, Madalena. So these strategic partnerships really hope to achieve gains on both the European and the African side, as well as building the relationship between Africa and Europe more generally. So on the European side, it's hoped that these partnerships will help facilitate Europe's access to critical minerals. And this is a key part for Europe to build out their own CRM supply chains independent of China in order to reduce their dependence on China's supply chains. Access to these minerals would also enable Europe to boost their industrial capabilities by basically giving European industry materials which they can work with for production. And importantly, this still falls under the broad umbrella of Europe's decarbonization objectives. So it's not departing from that, but is a means of strengthening Europe's way to achieve that. For African countries, these partnerships are hoped to basically encourage in European investors in both mining and value addition. It's hoped that having new and more diverse investors will increase competition in these sectors, and that would allow these governments to negotiate better deals that are more favorable to their countries. It's also hoped that these would, attract specifically like high quality European investors. So those who are committed to ESG standards, those who support more local value addition. Also, Europe has a very good reputation for leading technology and know-how and bringing that into the economy. And more generally, just having more activity in mining and value addition within African countries would allow them to really push forward industrialization, create jobs, increase foreign currency earnings, increase tax mobilization. So there are quite a lot of knock-on impacts that we would see on both sides. In terms of progress, since these strategic partnerships have been signed, we haven't seen much real new investment from the European side in these African countries. I would say, with the exception of Namibia, the Namibia strategic partnership also covers green hydrogen. And there's been a bit more momentum in the green hydrogen space, but within the mining and value addition sides, we've seen less progress. These partnerships have not been signed, that long ago. Namibia was 2 years ago, Zambia and DRC about a year ago, and Rwanda even more recently. So it is still quite early days in terms of being able to gauge progress. But we are seeing some challenges come to the fore, maybe explaining a bit on why we haven't seen as much progress as we would have liked. So the main challenge really is that these strategic partnerships were signed by EU public institutions, but it's really European private sector companies who are the ones who are needed to participate in mining and value addition activities in these countries. And also really the private sector companies who need to shift their procurement away from China's supply chains. And it's a bit unclear whether there was a lot of engagement on the European side to bring the private sector on board. before some of these commitments were made under the strategic partnerships. And so I think some of the progress or the lack of progress to date that we're seeing is still, trying to align the interests, the commercial interests of European private sector with EU public policy goals. And that's obviously a process that we're going to see take a little bit of time to really get interests to align. But I guess more broadly, the truth is that European companies are a bit hesitant in some ways to enter into mining and value addition in African countries. And there are a few different reasons for this. One is that, Europe doesn't have as many mining companies anymore as they did maybe a couple of decades ago. They are also quite concerned about the cost and difficulty of adhering to international ESG standards when they are operating in, I guess, particularly more undeveloped contexts in Africa, and also, I guess, more unfamiliar contexts to them. And in terms of global market dynamics, there are also some concerns around the economics of competing with China, particularly in mineral processing. So Europe has more limited capacity and lower economies of scale, as well as higher labor costs, higher electricity costs. And this will make it very difficult for Europe to compete on price terms with China. And so that also needs to be taken into account, in addition to, the fact that China's dominance within the mineral processing is such that they can manipulate global market prices for products. They could oversupply the market and trigger price drops. And it could be done intentionally, or it could just be done as a result of oversupply. But if that happens, it does really affect the economic viability of European companies trying to build out, their own operations within this space. So these are some of the realities that we're seeing coming to the fore as we're trying to understand what's needed really to move forward with the implementation of these strategic partnerships.
Thank you very much. Very helpful overview of the challenges, of the core challenges. And I want to pick on one in particular and ask Louis. Sarah, you mentioned ESG as an area of concern for European mining companies. Louis, can you help us understand a bit better how European companies, mining companies, view ESG standards? What concerns are there around these standards, and when considering basically mining operations in Africa?
Sure, thank you. I mean, European companies, mining companies, like other Western countries, mining companies view ESG increasingly as a prerequisite before considering any kind of investment. Speaking frankly, they don't always necessarily fully, of course they know ESG by heart, but depending on the company that you talk to, it may cover different realities. So a lot of the attention is focusing at the moment, of course, on environmental impacts, which is obviously very needed. But when you actually talk to a number of those companies, other things start to appear in terms of their own concern. One being that in a number of African countries, the rule of law is pretty weak. The overall governance is pretty weak, and corruption levels are very high. And that is something that, because of the various incoming regulations in the EU and in European countries, makes it probably more difficult for them to apprehend how they could operate in such complex environments, because increasingly they're pushed to approach those ESG questions in a very black or white kind of approach, which obviously doesn't help at all. And so when you talk to those companies, the one thing that they will say basically and explain is that before considering investing, they need to be sure that the ESG landscape is perfect. That cannot be true in Africa. It cannot be true anywhere else. And I think what European mining companies need to start understanding is that they can approach those jurisdiction having assessed the risks and having a good understanding of how they can actually mitigate those risks using their own leverage. You'll have something to say if you put money at the table. And I think, Jewett, your minister in Brussels last week was overly explicit about that. And it was a very good point. I mean, and this is what we keep saying. You can't dictate the terms of a contract you've not even entered into. And I think that that entire rhetoric and philosophy or approach needs to change very quickly. So that's on the European side. But again, on the African side, and we could say same things about a number of other jurisdictions. We haven't seen a lot of progress in a number of countries in terms of the overall level of governance or rule of law, which raises some legitimate concerns. And so the objective and the purpose for everyone, and including us, is to make sure that we can find a way to bring everyone to the table so that investors understand that they need to not lower their ambitions, but change their approach to these ESG questions. And on the other hand, see a bit more proactive progress in terms of number one, strengthening rule of law, fighting corruption at every level possible, protecting investments. So those things are the two, core parameters for me to make sure that at some point everyone manages to speak the same language.
Thank you very much. Indeed, we often treat Europe-Africa relations in this space as something of a relationship type of problem, but there are issues within each context individually. The Europeans have their own, and in African context as well. So it's a matter of working on multiple levels at the same time. And I want to turn to Jawed. I may come back on this ESG point a bit later, but now I just want to touch on upon another important point with Jawed, which is basically the fact that in order to attract investments, attracting investments is also a matter of ensuring that these investments contribute more to provide more local benefits, and that African countries benefit from this surge in demand for critical raw materials, in particular through local value addition. But as Louis mentioned, local value addition needs a lot of prerequisites that often are not extremely well present in African context. So I want to ask you, what do you see, what do you hope that is achieved on local value addition, and what are the efforts that are being made to achieve that, and how can EU institutions and the European private sector help on that front?
Thank you very much for that very important question. I will try and focus and base my discussion primarily on our experience here in Zambia. And in the Zambian context, the government earlier this year launched what is called the National Critical Minerals Strategy, which is supposed to last between 2024 and 2028. And in that strategy, the government highlighted or identified a number of minerals as being critical. However you may wish to define them, they identified lithium, graphite, nickel, cobalt, tin, copper, manganese, sugilite, uranium, rare earth metals, among others, as being critical. And this is important because I think that maybe at a later stage, I can use this in our discussion. However, as part of this strategy, the government has elaborated some very, very key expectations under the umbrella of value addition and local content. And I can use that to respond to your question. But before I go there, I think it is important to recognize, and you mentioned earlier in your opening statement, that China essentially dominates the critical minerals global supply. And so you will note that a significant proportion of China's critical raw materials are actually mined and produced within the African context, or off the continent of Africa. Now, the interesting thing about mining is that large-scale mining generally tends to advance sell its products. So you'll find that, mine A or mine B or C will have sold for 1 year or 2 years in advance its production. So when you start thinking about, for example, the EU beginning to have a role and a part within the African critical minerals sector, then my suggestion would be that the EU mining houses and others should start looking at what we would call greenfield areas, not existing ones which are running and someone has already advanced sold the product from there. Now, within the Zambian context, when we look at the critical mineral strategy, it identifies the fact that the Zambian geology is not that well known. In other words, about only 45% of the country's geology is understood. So the balance is not. And the government is now in the process of beginning to undertake very, very elaborate geological surveys to try and quantify. So for me, that creates an opportunity for entry for the EU immediately. Because when you start talking about exploration and so on, it's an opportunity for the EU to come in at that level and start talking about greenfield minerals. But however, so the government in Zambia, when it's talking about local value addition and so on and so forth, some of the things that they are looking for, which is where the EU, in my view, would have a role, they're saying they would expect an engagement between the government and other stakeholders on the issue of beneficiation and value addition. And the two, of course, are very distinct. Beneficiation is just processing up to a certain point, and then the value addition is essentially where you are transforming a mineral product into a consumable product. So the government is saying it expects its stakeholders, and in this case, when we say stakeholders, you can put in EU, to come in and say, look, please come in and be part of the beneficiation process so that you're not exporting raw and processed material out of the country. So do your beneficiation locally. And when you're doing value addition, do some value addition locally as well. So that's what the government is expecting. Two, the government has indicated that they are willing to look at the development or putting in place tax and non-tax incentives for beneficiation and value addition. So it's another opportunity there. And of course, there is also a statement of establishing what are called linkages to optimize opportunities in critical minerals in that particular value addition. Now, linkages talk about linkages between maybe mining houses or stakeholders in Zambia with, let's say, the EU, in terms of companies and others to increase optimization of the beneficiation process and the value addition process. And as I will mention a little bit later, this includes capacity building and human resource development. So the EU do have certainly an advantage over, let's say, Zambia or most African countries in terms of technological know-how and skills and so on and so forth. So there is an opportunity for the EU to come in that space as well specifically. And then there is an issue of, the government has mentioned that they want to create what they're calling a government fund for local content and annual procurement of in the value addition, meaning when the mining industry is buying its input materials, the government is saying, look, a certain proportion of that budget, and they've put a figure of 35%, should be sourced locally as far as possible. Now, if you look at that closely, some will say, well, maybe you don't have support industries to supply this material. Well, there's an opportunity for companies to come and set up businesses here in that upstream value chain. So there are opportunities in that regard. And then finally, of course, the one I wanted to mention is the one about human resource and technical capability development. So all of these things, if you add them, are to me, And I really like what Luis mentioned a little bit earlier, but what our minister said in Brussels, that look, if you want to be part of the process, come and sit at the table and then let us look at the specifics that are available. Then you can see what opportunities and consequently also what levers are available to you to use to make sure that the issue of concern about ESG, for example, and other things can be addressed within a particular context when you are at the table. I would like to stop there. Thank you very much.
Thank you, Juhat. All very important points. And I want to pick a little bit further on these, but bringing in Louis again, in the sense that you mentioned a number of things that could be opportunities for investors to contribute to setting up proper like industries and upgrade on the value chain. Now the problem for Europe, one of the questions is how to make sure that costs are taken into account in a way that make all these investments feasible, and it's also linked somehow to the fact of ESG compliance and the higher costs associated with ESG compliance. So I want to ask Louis, who is willing in Europe to bear these costs? Is the commitment to responsible sourcing important enough for European companies to favor these without financial incentives, or should subsidies be put in place for European producers to offset their higher costs of production? What kind of considerations are out there, and what are your thoughts?
Thanks. That's a very kind of popular yet sometimes oversimplified question to me. The first thing is that obviously European companies, and here we're talking more about off-takers and clients and buyers, they live within a regulatory environment that has changed quite a lot. So for them, to some extent, it's not really an option any longer to pay attention to those issues and of course start reporting on it. You know about the conflict management regulation and the battery regulation, and we have the CSDDD that's starting to kick in. So those companies need to actually invest in order to be able to understand their supply chains and understand where the risks are. We're at a moment in time where companies are, for obvious reasons, focusing on costs. And we fully understand that, but we're also trying to push them to understand what are the associated benefits of being part of more sustainable supply chains. Obviously, from our perspective, you'll never have anything such as a completely risk-free supply chain or fully sustainable supply chain, which is again something that sometimes companies in Europe fail to recognize. But investing in strengthening and upholding integrity in those supply chains at the end of the day for us tends to create more reliable supply chains for a number of reasons. So obviously right now, because of the evolving geopolitical landscape, because of the frenzy, because of the perceived tensions to secure access to deposit, etc., everyone is laser focused on costs and how can we cut down costs. And we're really trying as much as we can to kind of take a broader view at this, because companies are in for this for at least 15 to 20 years. Mining companies are in there for even longer than that. But buyers and international off-takers are also looking into those supply chains with a rather midterm to long-term perspective. And in order to secure those supply chains and make them reliable, it's very hard for us to argue that you don't need to invest into making those supply chain more responsible in the first place. The question now becomes, should anyone provide any incentives or subsidies or financial support to companies That's an open question. I always, when I get that question, I always really make sure that everyone has a good understanding of the potential unintended consequences. You always have unintended consequences. We've heard a lot about green premiums, but that question is extremely complex. Again, what should it apply to? Should it be only environmental considerations? Should it be only a handful of commodities? And if so, why? What could be the unintended consequences for other commodity producers? And I think there's, for the moment, because of what I still call a sense of hysteria around those issues at the moment, no one is really trying to take an overall overview of those considerations. Of course, companies will always say that they would like to receive subsidies, but I'm not sure it's our role to necessarily go for that without having first tried to get a good again, a good understanding of what the implications for this could be. So again, in the conversations, we've heard a number of things. We've heard premiums, we've heard price floor systems. There's a role, of course, for public procurement in general. That's not a subsidy. What we keep saying is that this is, in the end of the day, for a number of those companies, more of a market access issue than anything else. If they want to sell their products, in particular in the European markets, bearing in mind the evolving regulatory landscape, they actually don't, again, have a number of options. They have to invest in that. So it's probably a difficult moment in time, but that's basically what I was telling to a number of companies as well last week in Brussels. Like, keep doing this, and most likely will pay off in the short term, or let's say medium term.
Thank you. Thank you. I want to go straight to Jawed now and hear his thoughts on this. So what are like on costs and benefits of focusing on ESG? Can you tell us your perspective? Like, what's the plan in Zambia, and how do you also balance the fact that not every individual partner has the same ESG, has the same application of ESG standards as the Europeans? How do you balance this?
Thank you very much. That's an important question. We are just at the moment looking at our ESG regulations. We're doing a review, actually. I'm supposed to be in a workshop now, so when we're done here, I'll go back there. One of the things that we're looking at is making the mining houses legally more responsive to their ESG responsibilities. The current structure of the regulations are a bit thin in terms of detail, obligations and responsibilities, and therefore the means by which a yardstick can be applied to them on holding them accountable. So the idea now is to expand that and make it a lot more detailed. And I am not very sure if the government ultimately intends to insist that companies start making ESG reports. I am aware that some mining houses have begun, especially mining houses that have, like international homes have begun to report. But right now we're looking at it. Now, ESG is a crucial issue. For a fact, on the issue of environment, that is already legislated for. That before you give an access to a mining license, you need to look at the environmental issues that are associated with the site and then put in place a plan to manage all of those environmental issues as you operate right through to closure and beyond. So that's already legislated for and has been in place actually in Zambia since 1995. So it's an old thing. It's the EIA process and so on. So that's there. It's there. However, to a certain extent, there may be issues of shall we say enforcement on the government side. You have a piece of legislation where mining houses are responsible and expected to do certain things. As to whether they are doing them in the manner that is expected, that's another thing altogether. Because maybe the institutional enforcement capability is somewhat limited in terms of personnel, resources, etc., etc. So we do find that there is, shall we say, not a complete match between what the law says about the environment and what is happening in practice. So the social side is slightly behind the environmental obligations, I should say as well. Because the responsibility of mining houses towards, shall we say, host communities that are found around their mining houses and so on, is provided for, but is not that elaborate in the law. And that, I repeat, is one of the things that we're looking at. So that the S in the ESG should become much more, shall we say, detailed and stronger. And then, of course, the governance, the structure, and so on and so forth. That's sort of implicit, but we need to make it a lot more elaborate. So there is no doubt that the ESG component within Zambia and the African context needs to be developed further. There's no doubt about that. But I think those who are responsible are alive to that fact and are doing something about it. Thank you.
Thank you very much. It's important because often in Europe there's the perception that ESG are something that ESG standards are something that the Europeans are sort of bringing and imposing, and clearly there's instead like a clear developments in African context and also in other external powers or players in African context. So it's not in a way unique, and it sounds naive, but it's not. It's taken as one of the sort of often competitive advantages of Europe in operating in African settings and beyond. I want to come to Sarah, and then we try and wrap up and leave some room for questions from the audience. Sarah, given all that has been said, what do you think that, and clearly the dynamics from EU and African sides, what do you think is needed to encourage European companies to enter the mining and exploration and value addition in African countries? What would be your suggestions? What are the steps that need to be taken?
Well, it seems certainly from discussions that I've been having with European private sector that there may be a need for financial incentives or other support mechanisms to help reduce the risk that they face when, I guess, on the one hand, when they try to build out CRM supply chains outside of China, but also on the other hand, to do that through investing in African countries. So some of the things that have been raised, I mean, Louis did mention one of them just now, is this issue of potential like price floors or putting in price protection that would give European producers some protection against quite drastic price drops that might happen as a result of Chinese firms oversupplying the market and thereby manipulating global prices. So this would essentially be seen really as a sort of public financial institutions extending a guarantee to European producers to establish a price floor, but also, you know, potentially a price ceiling that would also limit the upside for European producers too. And this would remove some of the price volatility in the market, especially on the significant price drop side that could really imperil like the financial viability of European operations. But more broadly, there are some other aspects that have been used before that could be scaled up a bit more. So the use of political risk insurance, for example, to protect against losses that could arise from expropriation or damage arising from conflict in African countries. I think that happens quite rarely these days. So it's not as, as pertinent a concern as it might have been previously, but it is something that gives assurances to European companies. There is also a lot of consideration around European companies maybe partnering with companies from other countries, specifically, countries who are members of the Mineral Security Partnership, for example. This might be more relevant for some parts of the supply chain than others, and maybe specifically for mining, which might be the area where European companies are maybe a bit more concerned about going it alone. So going in partnership with others who might have maintained a presence in African countries in recent years could be a good option. Overall, I mean, European investors would be very encouraged by favorable investment environments in African countries. So if they really feel what is needed to for their value addition operations to thrive, it would really help encourage investment to come in. So this could, include access to the mineral inputs needed for production. So it touches on some of the aspects mentioned before about product often sold ahead of time. There's a need to make sure that that product is actually available locally for value addition to be built upon. There's also a need for access to reliable and affordable utilities, so especially electricity and water, easy access to markets. This could be domestic or regional markets, or even markets for export. And I guess specifically talking about the regional and domestic markets, I think there's also, it would help European companies a lot if there was more information on local demand for different value-added products. So, for example, there's likely to be much greater demand for energy storage batteries in a country like Zambia and many other Southern African countries, batteries that can stabilize the electricity grid, that could supply energy for mining and manufacturing operations. And that demand is a lot higher than, for EV batteries. I think it's going to be quite some time before we reach high levels of demand for EV batteries and local markets in Africa. So there's a real need to better understand what is needed locally, and that information could really help investors make more informed decisions on what they could come in and do on the value addition side. And then another aspect that Duet mentioned earlier is that actually a lot of the African countries have tax incentives for companies who do more value addition locally. So this is sometimes in the form of tax breaks or lower corporate income tax rates applying to companies who are doing this local value addition. And it shows the local government's commitment to really trying to facilitate these operations. And I believe, these provisions apply to both domestic and foreign investors active in those spaces. So these are all aspects that I think would really increase the attractiveness of doing value addition operations in African countries for European companies. And certainly areas where there are active conversations going on, both on the European and African side.
Thank you, Sarah. You touched upon a point that is kind of important, and we have a little bit sidelined in this conversation, which is also the geopolitical dimension and the competition and the potential for partnerships. And we have a question in the Q&A by Jeronima, who's asking what would be the incentives for European private companies to invest in mining operations in risky environments like Africa, where they could work with Chinese companies on different mid and downstream segments of the supply chain. He argues that economically this makes sense, it is cost effective and shields them from the reputational risk of operating in Africa. And I want to ask all three of you actually what you think, linking this to the point that you touched upon, Sarah, about partnering with others. These kind of, but the interdependence along this value chain is significant for everybody. No single country can achieve complete independence in this domain. And we are seeing alliances being built I want to hear your thoughts about whether these sort of groupings, like the Mineral Security Partnership or others that are being created, do make sense, if more cooperation or coordination on this front is needed, and if Europe should actually be considering partnering with less like-minded countries as they're defined, like China or other even Gulf players, for example. For you three.
Happy to take a first crack. I mean, essentially, that's what's going on. I mean, Europe and everyone knows this. Like European companies, US companies, Chinese companies, they're all involved in the same projects as joint venture partners, as co-investors, as clients, as buyers, as off-takers. There's been a very, very marginal shift in the past 2 years on this. But in general, I mean, and increasingly companies are going out public on this. Like last week, Ahmet, CFO, put out an op-ed in the Financial Times saying that there's no way they can run their nickel mine at a profit in Indonesia without the knowledge of the Chinese partners. And I think this is a reality that we all need to strongly come back to. Of course, there are sovereign imperatives, that there are. It makes sense, and I think even China can understand that. You know, Western countries want to reduce their dependency on China. But let's try to be rational as well. I mean, no one can completely create new supply chains duplicating. Like this is basically going to lead to overcapacity in a number of supply chains as well. So that's not cost effective at all. It's just a complete inaccurate allocation of capital, and hopefully at some point we will collectively get back to our senses. Again, referring to what I call the hysteria feeling that I have seen in the past couple of years. But so bottom line, yes, companies are doing this. Some companies are coming out saying, look, it's either this or I go bust. There are new players emerging. Some, like you mentioned, the Gulf. The UAE has made a very public entrance into Zambia recently. This is the only way it's going to work out. We just need to find the right terms of cooperation.
And I will be curious to know, maybe we can go around to Sarah and Joette first, but then Louis, I would be interested in hearing from you, what would be the right terms of cooperation? But over maybe to Sarah first.
Sounds like a difficult question you have coming, Louis, but I'll give you a bit of time to think about that. So no, I think it would be most realistic really to think about ways that cooperation can also be done effectively with China. And this can still feed into European objectives of, in some ways, reducing their dependence on just purchasing Chinese products. It can still feed into boosting European industrial capacity. And it still, you know, furthers the objective of decarbonization, which is the other aspect which is at stake here. If you raise the costs of inefficient, capacity expansion and that sort of thing, it will drive up the costs of some of these green energy technologies and put decarbonization at risk. And so it really is just a question of being strategic about where you can partner, making sure that you can still benefit in certain ways that are considered important, but trying to build out completely independent supply chains from China is not going to be realistic or the most effective approach moving forward.
Great, Joette.
Thank you very much. I was just going to say ditto to everything that Sarah and Louise have said. I think I'm in complete agreement that ultimately the issue of saying, I'll do it my way and only for me, as in, as geopolitics and so on, is expensive. And you will be duplicating, etc., etc. Whereas there are ways of leveraging relationships that could be built, and to a certain extent that could be managed below the argument that talks about sovereignty issues and so on. There are commercial opportunities, that's the point I'm trying to get at, that could work. The question is, does the political framework of the EU, for example, permit these business frameworks to function? That's a separate question. In Zambia, we've seen many cases where Chinese companies have taken over businesses that were previously owned essentially by Western companies. That has happened here. Mopani, that Louis just made the mention of, which was recently taken over by an investor from Dubai, is a classic example. It was previously owned by Glencore, which is a European company. So there are opportunities. The only issue is perhaps to a certain extent the politics. And I agree with Louis when he says, well, maybe there's a little bit of hysteria. Is there a way that we can actually live together and all of us benefit, all meet our objectives? Maybe there is a need to revisit some of our, fairly rigid political and strategic positions. That really would be my question. Now, from where I am sitting as an African here, what we want, I gave you a list of some of the things that we as a country, for example, are looking and expecting to see as a result of critical minerals and the opportunities that the resources we have in Africa are concerned. So the geopolitics of China versus EU is not really our concern because we can't even manage and influence it in any shape or form. The question is, how do we get our objectives met? Who is it that is going to work with us to deliver on them? And within the context of managing our issues on the continent, and even not just Zambia as a country, but as Africa at the regional level, at a continental level, we want an outcome that serves our interest, but also serves the interest of the investors if he's from outside Africa, so to speak. That's really the question. And that's
Duet, you froze. The others, is it me or it's him? Sarah, can you move? Okay, you move. Okay, he's back.
And are willing and are available to discuss the details.
Okay, Duet, we hear you pretty bad now. I think there might be a connection issue. We heard. Hello. Yeah, now you're back. Sorry, can you just repeat maybe the last point, the very last point? We lost you.
Thank you very much. Sorry about that. No, all I was saying was that when all is said and done, from an African context, Zambia and Africa, we are clear in our minds what our strategic objectives are. And we believe that it is possible for us with our investment partners, if they come from the EU or from China, to negotiate together to get a win-win outcome. That's really what we're looking for. And I think that within the framework of what we have put there and within the framework of what the EU strategically is thinking about, it is possible to get an outcome that is beneficial, but is also financially successful on all accounts. So all I'm saying is, let us get together and let us talk and have a win-win outcome. Thank you.
Yeah, sometimes there's focus on the differences and not on some of the complementarities or similarities or shared objectives. And one of these could be decarbonization, irrespective of the fact that each country has a different pathway and different pace. But no, thanks a lot for these. Before maybe going back to Louis, there is another question, and because the time is running out, I don't want to miss it, from David McNair. He's asking about basically risk pricing and cost of capital, the issue of being considered as inhibiting the commercial viability of investments, and he's asking how much is this a factor when it comes to critical mineral deals, and if so, if there are any steps that the EU and Africa could do together to address these. Some of the suggestions he puts forward is prudential regulation, data investments, and so forth. Who would like to take the question?
It's I guess completely true. I mean, at the end of the day, those investments need to make commercial sense, and a lot of those critical minerals supply chains and markets are rather small, fairly new. Investors don't know them. You don't have a lot of liquidity. You don't have a lot of players. You have a lot of opacity. So it doesn't make much sense for a number of investors, in particular those that are not knowledgeable and I don't know the mining industry. And as a result, you still see most of the investment going into gold when it comes to mining. Gold is attracting more capital than the rest of supply chains. And that's because there's a point, there's a business case. That's exactly what makes it so difficult and so challenging. To some extent, one might also think that this should leave us to believe that this could not be left entirely into the hands of the private sector, because the private sector responds to what makes a business case, whereas policymakers have a different role to play, and they see the value of those minerals as input and feedstock for industrial supply chains. And I think we're stuck in that conversation at the moment. Policymakers trying to convince private sector to invest when there's no business case. In Europe, it doesn't work like that. Probably in the US, it doesn't work like that either. In China, it may for different reasons. In the Gulf, it may for different reasons. But that sort of narrative that because policymakers have identified a need for their industry at large, that private investors will go in, that's just simply not the case.
Thank you. This is one of the issues that we raised also. We've been raising at ECFR the need to close the gap between the policy ambitions and the reality on the ground and the market realities. The fact that the market doesn't necessarily follow policy, if not with specific incentives. There are another couple of questions in the chat in the Q&A box, and I want to try and go through them. One is actually though on China, and I think we covered most of it already. The fact that somehow there's no chance for Europe at the moment to fully compete on its own against China. Probably there's no chance by any other country at the moment. The other question that is kind of we haven't touched upon it is the issue of the EU signing an MOU with Rwanda and the kind of diplomatic or reputational issues that these could bring on board, considering the conflict in the DRC. I was wondering if any of you wanted to answer this question. We've been asking why Rwanda, and so this question speaks to that.
I'm happy to jump in with an initial answer here. I mean, I think both from the Africa program at ECFR, like some of our discussions, but also speaking to African stakeholders, the EU signing a strategic partnership with Rwanda has negatively impacted the EU's credibility in this space. It's well established that Rwanda exports more on the mineral side than it produces itself, and the illegal movement of minerals from Eastern DRC has been documented, and there is a fear that a strategic partnership of this nature, building out sustainable CRM value chains in Rwanda, would encourage more of that it could destabilize relationships between DRC and Rwanda, but also more broadly in the Great Lakes region. So there is a lot of concern really around that deal being signed, certainly from an African perspective.
Just quickly building on that, I think it's more a matter of the perception that nothing is really actually articulated, that there was no proper coordination between the signature of the DRC strategic partnership and the signature of the Rwandan one. You could very well make the case that European is entering into a strategic partnership with Rwanda to precisely like iron out the various issues that remain in those supply chains. We all know, and it's been indeed documented that there is smuggling, but you also have a lot of legal trade going on between the DRC and Rwanda. You could leverage that for bigger objectives. I think what the EU is suffering of is the lack of articulation and the lack of strategic, ownership of this matter at the EU level. And speaking bluntly, it's not because you're signing strategic partnership that you really have a strategic understanding of what you're doing. I think that's what's missing at the heart of the EU communication. I'm not saying that it doesn't exist. I'm saying that the EU is not communicating well on this probably, and should pay more attention to that. And for sure, like the sequence of the signatures of those two strategic partnership could not have happened if you had that kind of strategic thinking around critical mineral supply chains in the EU at the moment. It's slowly getting there, but that was a very good example of an easy mistake to avoid.
Yeah, agreed. Fully agreed. There is one last question, and we ran over time, so I think it's time to conclude. But maybe I can leave it with you to just a 30-second answer, which is I think it's interesting, and it's big picture question whether Europe is ready for a paradigm shift of real shared progress and prosperity with Africa. 30 seconds to each of you, and then we close. Who wants to start? Sarah, maybe you go ahead.
I can start. So I think that there are some aspects that need to shift paradigm-wise for mutual prosperity. I think there's a lot of work that still needs to be done on the European side to see Africa as a market in and of itself, and not just a supplier of minerals, or even as a potential location for manufacturing activities, that there is purchasing power on the continent. There are specific needs and demands and things that people are willing to pay for, and to think about serving that market and not just using Africa in a way to serve the European market. So I think there is an aspect there that progress needs to be made on.
Okay, Joette, over to you.
Thank you very much. My view is that the African continent has moved quite a lot, or quite a bit, from seeing itself as a source of raw materials. And you can look at the African mining vision, where it talks about the African continent looking at its mineral resources as a tool for industrialization and so on. So I think that if the EU were to engage Africa within that context, then absolutely there is room for a mutual win-win situation to come out. And I think that the EU would also stand to benefit quite a lot from that potential positive engagement. There are so many other opportunities. And they even, you have to look at, like Sarah was saying, you have to look at Africa beyond even minerals that are there. And I think that conversation needs to be held. Thank you very much.
No, I mean, just very quickly, I think we've raised a number of points already, but I think was something that I was really interested in Jua's in initial comments was that African countries want more international partners, because the more competition you have, the better deal African countries are likely to get. And I think that's probably something that Europe as a whole needs to factor in more seriously, that Europe is one of the competitors, and then it needs to come up with compelling arguments that will convince African governments and African public opinions that it's interesting to work with the EU. And it's not just because of the beautiful eyes of the EU that something can happen. And it's not necessarily just because of ESG either. Again, coming back to the business case, there needs to be a business case on both sides of the table, including for African countries.
Thank you very much, Louis. And yes, I fully agreed also on your point earlier on the need of strategic communication. Sometimes the strategy or hints of it are there, but the communication is not up to it. Thank you all very, very much. We ran a little bit over time, but the discussion was very rich and interesting. Thank you for taking the time. We have a new policy brief coming out today by another colleague of ours, also focused largely on the mineral space, and we will continue working on these topics in the coming months. So watch this space, and looking forward to engaging with many others of you also from the audience. Thank you very much. Have a happy Christmas for who celebrates.
Thank you very much.
Thank you.
Thank you for the kind invitation. Bye-bye.
Likewise, bye-bye.